Hycroft mining, i-80 gold, and McEwen mining represent distinct strategic approaches to capturing value in the mining jurisdiction of Nevada. While all three operate in Nevada, their development stages, technical hurdles, and capital structures offer vastly different risk-adjusted considerations. As geopolitical tensions persist and global trade remains volatile, the United States has intensified its focus on securing domestic sources of critical and precious minerals. Nevada is uniquely positioned to benefit from this onshoring of mineral wealth. The primary challenge in the state remains the processing of refractory sulfide ores, a technical bottleneck that requires massive capital expenditure for autoclaves or roasting facilities. Hycroft, i-80 Gold, and McEwen are at the forefront of addressing this bottleneck. Hycroft is reimagining a massive historical heap leach mine as a large-scale sulfide milling and roasting complex. i-80 Gold is executing a regional hub-and-spoke model centered on its independent autoclave facility. McEwen Mining is leveraging a diversified production base across the Americas to fund ambitious growth targets, including a significant stake in one of the world's largest copper development projects.
Hycroft Mining possesses the largest undeveloped precious metals resource in North America, with a measured and indicated resource of 14 million ounces of gold and 457 million ounces of silver. Historically viewed as a low-grade heap leach operation that struggled under previous management. The defining event for Hycroft in 2025 was the total elimination of its debt, a move that fundamentally altered its institutional appeal. The company's inherited debt, which was accruing at a 10% rate and increasing liabilities by $1 million monthly, was an insurmountable barrier to institutional capital. By raising approximately $235 million in net cash proceeds through equity offerings and warrant exercises, the company prepaid and eliminated $136 million in total indebtedness. As of late 2025, Hycroft transitioned into a debt-free entity with an unrestricted cash position of approximately $175 million. This liquidity is further bolstered by anticipated proceeds of $41.3 million from warrant exercises scheduled for January 2026. The current ratio of 19.04x reflects a balance sheet designed to survive the multi-year development cycle required to permit and build a large-scale mill.
Hycroft Mining key financial metrics. Cash and cash equivalents increased from $49.6 million in 2024 to $139.1 million in 2025. Total net debt reduced from $125 million to zero following the October 2025 elimination of the 10% interest burden. Current ratio improved from approximately 9.4x to 19.04x. Institutional ownership grew from roughly 7% to approximately 80%. Shares outstanding increased from 24.9 million to 54.6 million, reflecting 2025 equity funding activities. The second pillar of the Hycroft thesis is the discovery of high-grade silver feeder systems. For decades, the Hycroft mine was exploited as a surface-level bulk tonnage heap leach operation. However, the technical team hypothesized that the massive low-grade shell was the result of high-grade plumbing systems at depth. This led to the discovery of the brimstone and vortex systems, where silver-to-gold ratios can reach 3,000 to 1 and 600 to 1 respectively. Recent drill results at Vortex have been among the most significant in the project's history, with intercepts showing 18.2 meters of 1,987 grams per ton silver and intervals exceeding 10,000 grams per ton silver. These systems remain open in all directions and at depth. The 2025-2026 exploration drill program, utilizing 4 rigs, is specifically designed to expand these high-grade zones to support a mine plan that could prioritize high-margin silver-rich ore in the early years of operation.
Hycroft is currently focused on the engineering work required for a large-scale sulfide milling operation. Metallurgical test work has demonstrated that flotation processing can achieve 89% gold and 93% silver recovery, which represents a massive improvement over historical heap leach performance. The company is also evaluating roasting as a potential processing route, which could generate sulfuric acid as a byproduct for the lithium and industrial markets. A technical report with updated economics is expected in late Q1 2026. This report will incorporate the 2023-2024 drilling results and provide the first modern economic assessment of the project at current metal prices. Furthermore, the company is evaluating a potential restart of heap leaching for its oxide material in the first half of 2026, which could provide early cash flow to offset development costs. The bull case for Hycroft is predicated on its status as a massive, debt-free optionality play on precious metals. With nearly 500 million ounces of silver in the ground
Every $1 move in the silver price adds nearly $500 million in theoretical asset value. If the Q1 2026 technical report demonstrates robust economics at $30 plus silver and $2,500 plus gold, the company could undergo a multi-fold re-rating to trade closer to its net asset value.
Management's success in attracting blue-chip institutional investors who now hold 80% of the stock suggests that the smart money is betting on the technical team's ability to solve the refractory ore processing puzzle. Furthermore, the onshoring narrative for silver and gold makes Hycroft a strategic asset for the U.S., potentially opening doors for government-backed initiatives or favorable permitting pathways in the future. If the vortex and brimstone systems continue to expand, Hycroft could transition from a development story to one of the most significant silver producers in the world by the end of the decade. The primary bear case for Hycroft remains technical and financial execution risk. Refractory sulfide deposits are notoriously difficult and expensive to process, and the history of Allied Nevada's failure at the site remains a lingering concern. While the current team is highly experienced, any metallurgical underperformance in the full-scale mill could devastate the project's economics.
Financially, while the company is currently debt-free, the capital expenditure for a world-scale mill and roasting complex will likely exceed $1 billion. Securing this financing will almost certainly require significant equity dilution or complex royalty and streaming agreements that would cap the upside for current common shareholders. Additionally, the stock's massive rally and its high price-to-book ratio suggest that much of the optimism is already priced in, leaving little room for error in the upcoming technical studies. Insider selling has also been noted, which can be interpreted as a lack of conviction in the current valuation. i-80 Gold is positioned as the premier mid-tier gold developer in Nevada, utilizing a hub-and-spoke regional strategy to maximize the value of its high-grade underground assets. The company is the fourth-largest gold resource holder in the state, with assets that are strategically located along Nevada's most prolific gold trends. The centerpiece of the investment thesis is the Lone Tree Central Processing Facility. i-80 is one of only 2 gold companies in Nevada that controls an independent autoclave processing plant. This is a critical advantage because most Nevada gold is refractory, requiring an autoclave or roaster to achieve acceptable recovery rates. By controlling Lone Tree, i-80 can avoid the high costs and low payability associated with third-party toll milling.
A 2025 engineering study for the Lone Tree refurbishment estimated a capital cost of $430 million, with a nameplate capacity of 2,268 tons per day. Transitioning from toll milling with 60% recovery to owner-operated autoclave processing with 92% recovery is expected to increase margins by $400 to $600 per ounce, fundamentally transforming the economics of the company's satellite mines, like Granite Creek, Archimedes, and Cove. Mine life of Granite Creek is approximately 8 years, based on PEA, with feasibility results and the South Pacific Zone potential for extension pending. Annual production from 30K to 40K ounces in 2025, with a target to reach 200K plus ounces by 2029 as part of a phased mid-tier growth plan. i-80 is currently ramping up its first underground operation at Granite Creek. Despite technical challenges related to water ingress, which required significant pumping system upgrades in early 2025, the project is advancing towards steady-state gold output. A predictive groundwater model completed in 2025 has allowed the company to stabilize mining rates and reduce interruptions. The 2025 drilling at the South Pacific Zone of Granite Creek has been successful, confirming the continuity of robust high-grade mineralization, up to 40.4 grams per ton gold over 13.2 meters, and suggesting significant resource expansion potential to the north. These results will form the basis of a Granite Creek feasibility study expected in Q2 2026.
i-80's primary headwind has been its balance sheet and liquidity, with a current ratio of 0.33 and a reliance on gold prepay and silver purchase agreements. However, management is currently executing a $1 billion recapitalization plan to fund the Phase 1 and 2 development through mid-2026. This plan involves multiple funding sources. Asset monetization. The non-core FAD polymetallic property is being marketed for sale, which could raise $50 million to $100 million. Royalty sales. Negotiations are advancing for a portfolio-level royalty structure. Senior debt. 3 groups are currently advancing term sheet negotiations for a senior debt facility. Equity. Approximately $300 million was raised through Q2 2025.
The completion of this recapitalization by mid-2026 is expected to shift market focus from financing uncertainty to project fundamentals. The bull case for i-80 is centered on a massive valuation disconnect. At current spot gold prices, the portfolio's net asset value is estimated between $8 billion and $10 billion, yet the company's market capitalization remains near $1.4 billion to $1.5 billion. This implies the stock is trading at roughly 0.1x NAV, a level typically reserved for companies in severe distress or with unpermitted assets.
If i-80 successfully completes its recapitalization and begins the Lone Tree refurbishment, it will become the only independent, vertically integrated gold producer in Nevada with its own autoclave. This makes it a prime acquisition target for seniors like Barrick or Agnico Eagle, who may want to secure the Lone Tree infrastructure for their own regional satellite deposits. With gold prices at historic highs, the leverage of i-80's 600,000-ounce annual production goal by 2030 offers explosive upside for patient investors. The bear case for i-80 Gold is rooted in the going concern doubts raised by its auditors and the massive capital requirements of its expansion. The company has a weak balance sheet and high levels of debt and pre-obligations, which could lead to severe dilution if the recapitalization plan fails to materialize on favorable terms. Any delays in permitting the Lone Tree refurbishment or the Archimedes underground expansion would further strain its liquidity. Operationally, the technical challenges at Granite Creek, specifically water management, have highlighted the risks of underground mining in Nevada. If these costs continue to escalate, the company may struggle to generate the cash flow required to self-fund even a portion of its development. Finally, the stock's historical volatility and high beta make it a high-risk vehicle for those not comfortable with sharp market swings. McEwen Mining offers investors a unique hybrid model, a current gold and silver producer with exposure to a world-class copper development project. The company is led by Rob McEwen, the founder of Goldcorp, who remains the primary owner and has invested over $200 million of his own capital into the firm. The primary differentiator for McEwen in 2026 is its 46.4% ownership of McEwen Copper, which owns the Los Azules project in Argentina. Los Azules is one of the world's largest undeveloped copper porphyry deposits. A 2025 feasibility study for the project outlined an NPV 8% of $2.9 billion and an IRR of 19.8% based on a $4.25 per copper price. The project has been significantly de-risked by its inclusion in Argentina's RIGI incentive regime, which provides 30 years of tax and foreign exchange stability. Given the accelerating global demand for copper to support the energy transition, the implied market value of McEwen's stake is approximately $456 million, providing a massive copper kicker to its gold and silver production.
McEwen's own gold operations have faced headwinds in 2025, with production guidance lower to 112K, 123K GEOs, and AISC rising to nearly $2,400 per ounce. These high costs were primarily due to lower grades and high waste stripping at the Gold Bar mine in Nevada, as well as inflationary pressures in Argentina. However, the company is pivoting towards its Fox Complex expansion in Ontario as a source of lower-cost ounces. The stock mine is expected to begin production in mid-2026, benefiting from existing infrastructure and softer ore that will reduce milling costs. This is part of a broader strategy to double annual production to 250,000-300,000 GEOs by 2030. McEwen has been aggressive in consolidating its land position around the Gold Bar mine complex in Nevada. In January 2026, the company entered a definitive agreement to acquire Golden Lake Exploration and its Jewel Ridge project. This acquisition adds adjacent high-grade mineralization and allows McEwen to utilize its existing Nevada technical team and infrastructure to expand resources without massive new capex. The 2026 exploration budget for Gold Bar is set at $10 million, focused on bringing these new areas into the production plan.
The bull case for McEwen is based on the value of Los Azules. As one of the few junior mid-tier producers with significant copper exposure, McEwen is a unique vehicle for investors who want a one-stop shop for the metal supercycle. The approval of RIGI in Argentina is a transformative event that could lead to a strategic investment in Los Azules by a major copper producer, which would crystallize the asset's value for McEwen shareholders. If McEwen can successfully bring the stock mine online in 2026 and reduce its consolidated AISC toward the $1,700 to $1,900 range, the company's free cash flow will significantly increase in the current $2,800 plus gold environment.
The stock's dual listing and high liquidity make it a favorite for institutional funds looking for a well-aligned management team with a history of building multi-billion-dollar companies. The bear case for McEwen is focused on its high cost of production and geographical risk. With an AISC exceeding $2,400 per GEO at some sites, McEwen is a high-cost producer that could see its margins evaporate if gold prices pull back toward the $2,000 level. The company's history of downward guidance revisions has created a credibility gap with some investors who view its growth targets as overly ambitious. Furthermore, while Los Azules is a world-class asset, its $3.2 billion initial capex means it will require massive project financing that could further dilute McEwen Mining's interest or require it to take on significant debt. Political and inflationary risks in Argentina remain a persistent threat to both the San Jose operations and the development of Los Azules. Finally, valuation metrics suggest the stock is trading at a significant premium to its peers, leaving it vulnerable to a sharp correction if any of its 2026 catalysts face delays.
Comparative financials. To provide a comprehensive investment perspective, it is necessary to compare these three firms across standardized metrics that reflect their different operational stages and risk profiles. Hycroft Mining enters 2026 in the strongest financial position, with a debt-free balance sheet and nearly $200 million in cash and scheduled warrant proceeds. This provides a definitive safety net for long-term development. McEwen Mining maintains moderate liquidity with approximately $62.6 million in working capital and access to capital markets, but it also carries $130 million in debt. i-80 is in the most precarious position, with low liquidity, current ratio 0.33, and a high debt prepay burden, making its mid-2026 recapitalization a make-or-break event. When looking at the value the market assigns to each ounce of gold or silver in the ground, Hycroft and i-80 trade at significant discounts to McEwen on an enterprise value (EV) basis. Hycroft's massive resource base of nearly 20 million gold-equivalent ounces means it trades at a low EV per ounce, but this is tempered by the fact that it is not yet producing. i-80's valuation is heavily suppressed by its financing risk, but its high-grade underground ounces are theoretically more valuable than Hycroft's bulk tonnage material. McEwen Mining's valuation is supported by its production status and the implied value of McEwen copper, leading to a higher EV per producing ounce.
The primary technical differentiator between these three companies is their approach to Nevada's refractory ore bottleneck. This choice determines their long-term cost structures and their ability to become Tier 1 producers. i-80 has chosen to invest in an autoclave facility at Lone Tree. Autoclaves use high pressure and temperature to oxidize sulfur and release gold. This technology is highly proven in Nevada and offers recovery rates above 90% for most refractory ores. The risk is the high upfront capital cost and the technical complexity of maintaining pressure oxidation vessels. For i-80, this represents an infrastructure moat that makes its satellite deposits far more valuable. Hycroft is currently focusing on a sulfide mill using flotation to create a high-grade concentrate. Beyond that, the company is studying roasting as a secondary step. Roasting is a traditional Nevada technique that involves burning off sulfur at high temperatures. The benefit of roasting is the ability to handle a wide range of sulfur content and the potential to produce sulfuric acid as a byproduct. However, roasting faces higher environmental scrutiny due to gaseous emissions. McEwen Mining's Nevada operations at Gold Bar are currently focused on oxide ores that can be processed via traditional heap leaching. This is the lowest cost processing method, but it is limited by the availability of oxide material. By acquiring Golden Lake, Jewel Ridge, McEwen is specifically targeting additional oxide gold that can be processed immediately using its existing Gold Bar leach pads, avoiding the need for a capital-intensive sulfide plant in the near term.
For Hycroft, the market will be focused on the capital intensity revealed in the Q1 technical report. A capex number below $1 billion would be a major positive surprise, whereas a number above $1.5 billion could lead to concerns about future dilution. For i-80, the only catalyst that matters in the first half of 2026 is the completion of the recapitalization. Once the balance sheet is stabilized, the market can begin to value the company on a price-NAV basis, which suggests significant upside from current levels. For McEwen Mining, the focus is on operationally delivering the stock mine and the El Gallo construction. If Rob McEwen can prove that the company is successfully lowering its AISC, the stock will likely maintain its premium valuation.
The three companies represent a hierarchy of risk and leverage within the Nevada mining ecosystem. Hycroft Mining is the leveraged play on the silver and gold bull market. It possesses the largest asset, the strongest balance sheet, and the most significant institutional support, but faces the longest road to commercial production. It is a top-down macro play for those who believe in $3,000 gold and $50 silver. i-80 is a bottom-up value play on infrastructure and high-grade geology. It offers the most significant per-share upside if it can navigate its current liquidity crisis. It is the preferred vehicle for sophisticated mining investors who understand the strategic value of the Lone Tree autoclave. McEwen is a diversified growth play with unique copper optionality. It offers the security of current production and the pedigree of its leadership, but investors must be willing to pay a premium for that exposure and accept the operational volatility of its higher-cost mines.
Conclusion. In the current record-high gold price environment, the execution premium is becoming the primary driver of share price performance. While exploration success provides temporary boosts, institutional capital is increasingly flowing toward companies that can demonstrate a clear pathway to free cash flow. The analysis suggests that Hycroft Mining is currently the most de-risked from a financial perspective due to its debt-free status and cash reserves, making it the safest haven for development stage exposure. i-80 offers the highest alpha potential if the recapitalization is successful, as its market valuation is currently most disconnected from its underlying asset value. McEwen Mining remains the strategic choice for those seeking diversified metals exposure, especially given the generational nature of the Los Azules copper project.